Morning, everyone. Thank you very much for joining me. This is the morning market review. My name is Russell Shaw, Senior Market Specialist at FXCM. My email address is rshaw@fxcm.com. And today is it's actually Wednesday, the 29th of June, 2022. So sorry about that. That's a Wednesday. Let's just bring up our high risk investment warning. I'm going to keep this on screen for a few moments. And here is our market commentaries disclaimer. And references, MarketScope 2.0, CNBC, and TradingView. So we'll take a look at the real rates again. But before we do that, let's go to the article from CNBC, which headlines as follows: European markets set to slide at the open as investors weigh up the economic outlook. European stocks are expected to slide at the open on Wednesday as global sentiment remains volatile and investors monitor the economic outlook. The lower open anticipated for European markets comes amid declines elsewhere overnight. In Asia Pacific markets, Hong Kong shares led losses on Wednesday, with stocks there taking the negative lead from Wall Street. US stock futures were flat early on Wednesday after the major averages made a failed attempt at a bounce in the previous session. Asia Pacific markets have been buoyed Tuesday after China's decision to halve the COVID quarantine period to 7 days, with a further 3 days spent at home, which gave markets a signal that Beijing is relaxing its strict approach to eradicating COVID-19. In other news, investors will continue to watch for news out of the NATO summit in Spain on Wednesday, as well as the European Central Bank's forum in Sintra, Portugal. There was a moment of news from the NATO summit in Madrid on Tuesday, as NATO Secretary General Jens Stoltenberg announced that a deal had been reached to admit Sweden and Finland after objections from NATO member Turkey had been resolved. Earnings come from H&M and Mulberry on Wednesday. Data releases include Eurozone consumer confidence figures for June and Spanish inflation data also for June. All right. So yesterday we took a look at the real rates. I think that we still got to keep an eye on it. There looks to be some sort of continuation pattern here. Try to zoom in. It's a bit far. So there's some sort of it looks to me some sort of continuation pattern, perhaps falling wedge. We've broken out, kind of retesting, and we have at the bottom here is the correlation coefficient of the real yield, okay, which is the way I've worked it out is of taking the 10-year minus the 10-year break even, and I put a correlation coefficient against the US dollar, and if we go back to March, which I think is a key month for markets, because that's when quantitative tightening was announced. So that's why I like sort of using that as an anchor and seeing how the relationships are developing from then. So you can see from March. So if we have to take this back to, it was on the 16th that it was announced. So you can see that it was, the market sort of moves into a positive correlation after that, linking real rate to the US dollar. So as long as real rates continue to move up, and as long as the correlation coefficient holds, which I know at the moment suspect it will, again I'm going to tag on subject to correction onto that, but I would find it a challenge trying to find the fundamental reason that it would disconnect. But we've got a remarkable reading here, 0.94. So just to give you an idea of what we're looking at here. All right, let me just bring this in. This is from yesterday. We can clear this. So correlation coefficients play a really important role in market analysis and especially in portfolio management. There are 3 levels that we need to keep an eye on. So we've got +1 here, and we've got -1 there, and we've got 0 here. So we won't go into it except to say that if we get to +1, it's perfectly correlated. In other words, whichever 2 instruments you are measuring, they're going to be moving completely in tandem with one another. That's +1. All right. But that's what we've got. We've got 0.94, 94%, extremely strong. So what tends to happen, correlation coefficients don't fix indefinitely. So at some stage, this correlation will weaken. But I don't know when. With the quantitative tightening, there is this huge incentive for these 2 instruments to lock up. In 10 minutes, we will take a look at the real rates to Bitcoin, right, to see what that is. But not in this webinar. We'll do it in the crypto minute. So we'll separate. The idea that there's such a strong correlation between these, and the fact that we are in an interest rate interest hiking environment, makes it almost, in my opinion, sort of if you kind of a sniper, it gives you an exact target of what you can target depending on this correlation coefficient. So just for example, and this is education, not advice, I'm not a license, but Euro US dollar to me is just that. This is my go-to trade at the moment. So every time there's a bounce in Euro US dollar, I'm just waiting for the resistance to kick, and every time it kicks in, I'm going to take short every single time. So and until we get that correlation coefficient broken, then I'll move on to greener pastures. This is and it doesn't always work out. I mean, here, okay, where was the one I went on before? So this is the one that I showed you guys previously. Across there, went down. We had a really nice movement here. Unfortunately, I had a cut over here. I think I cut out for like 15 pips or something. I can't quite remember. Here's sort of a nice one. By the time this came through, unfortunately, this one was a loss because I was able to get in here. We spoke about this actually on one of the morning webinars because it hadn't fallen as much until after the webinar. So they're putting in a short position here. This one isn't such a good one. This one turned out to be a loss over here. So sort of a slight gain, slight loss. These probably do to a large degree. These are going to negate one another. These negate each other. Then we move here. Okay. Here's the next one. Okay. So now I don't know where this is going to go, but as soon as the signal's given to exit, I'll exit. But the stop's already been trailed. Right? It's been trailed down. So there's a huge in terms of most of your trades are going to cancel each other out. Most of them will. That's good. Okay, we've got to accept that small losses are going to offset small wins, and small wins are going to offset small losses. That's good. Okay, that's exactly what we want, because that's going to keep us at the mean. That's exactly what we want. We want small losses to offset small wins, and we want small wins to offset small losses. Now, you do that consistently, you're going to maintain this position. you'll maintain this position. Okay, so that's what you want to do. You want to maintain your average. Okay, what you also want to do is you want to cut your tail off. Okay, you want to cut your tail off. So the red vertical to the left, you know, that's the first standard deviation. You don't let anything go past the first standard deviation. That's where your stop losses come in. And then between the first standard deviations to the left and right, those are just going to offset one another. That's a good thing because that's going to will keep you centered, right? It keeps you around the center. It doesn't actually keep you around the center, by the way. It keeps you slightly right of center because you've cut off your left tail, which is terrific. Okay, and then at some stage, if the correlation coefficient holds, you're going to get a that goes past the first standard deviation, and that's where your trading account benefits. So the offsets here, these are good. These need to embrace small losses, small wins. They're nothing trades. Okay, think about it. They're nothing trades. These shouldn't bother you one way or the other, but they're absolutely necessary because this is going to keep you centered around the mean. Okay, but then if you this one was small win, this one was a small loss. These two cancel each other. Okay, here's the next go. I don't know where it's going to end. Maybe it's also sort of an average trade. Then I'll wait for the next one. But eventually, if the correlation coefficient holds, then we go past the first standard deviation on the right. Then we start collecting the pips. So what you doing effectively by working the small losses, working the small wins, is you keeping yourself, because you've cut off the left tail. If you haven't cut off the left tail, you're going to blow up your trading account. Just to get, like, truthfully, if you don't cut off your left tail, you're going to blow up your account. Mathematically, you will. Okay, but if you cut off the left tail, okay, you're going to develop a positive. Skew, okay, statistically, and letting the small wins and small losses offset actually going to push you over here. Okay, so it's going to move you to the right. Statistically, it will move you this way because you've cut off the left tail. Okay, so you have to cut off the left tail. If you can't cut off the left tail, you will. Like, I'll make a statement that, as a matter of fact, you'll blow up your account. So you have to cut off that left tail. All right. So that is kind of the way I'm working the market. I'm really looking more than euro US dollar, to be quite honest, because it's sort of just such a cool trend. Now you've got to often fight tooth and nail to find these beautiful trends. You know, here's just one that's it's getting it. I'll be honest, it's getting a little challenging. I'll show you where it's getting challenging. There's sort of like a harmony here, that pulse that we're talking about, that kind of love-dub type of thing, you know. Go down. So this is where it's getting a little challenging. Just this last leg is interesting, you know, because it kind of loses the lower trough here. But I suspect, this again, I'm going to tag on subject to correction, is just a matter of time before we go here. How come quantitative tightening? Okay, so it just seems the most sense. And then if you take a look here, you're going back into that lower quintile. Go through to the daily. Looks like we're going back into zone 1, zone 3. If we go back into zone 3, I'm hoping to get something like that. Okay. So that's kind of the thinking there. All right. Katie, just saw your good morning now, so good morning to you. I'm going to conclude at this point, and we'll go across to our crypto minute. Thanks very much for joining. We'll carry on in the crypto minute. We'll just need to keep it separate for compliance reasons. Thanks very much, guys.